Hello, I'm Ben Wattenberg. The stock market rises and falls and rises and falls, but one line keeps going up, up and away. Each year, greater proportions of Americans are investing in financial markets. The bull market of the 1980s and the 1990s has fueled a rise in ownership of individual stocks, bonds, mutual funds, 401ks, IRAs, Keoghs, Roths, and a wide variety of profit-sharing plans. That same bull market has also led to a mainstream proposal for a partial privatization of Social Security. Some observers think it's all great news. Others think this bull market optimism is partly bull. Joining us to sort through the conflict and consensus are Hedrick Smith, author of Rethinking America and host of the PBS series Surviving the Bottom Line; Dallas Salisbury, president of the Employment Benefit Research Institute; and Michael Tanner, director of Health and Welfare Studies at the Cato Institute. The topic before the House, the surge of people's capitalism, this week on Think Tank. There has indeed been a surge in people's capitalism. Let's look at the numbers. According to a recent study published by NASDAQ, 43% of Americans owned stock in 1997, compared with just 10% in 1965. 25 million Americans now participate in 401k plans, up from 10 million in 1985. More and more companies have employee stock ownership plans whereby every employee has a stake in the company's profits. Stocks and bonds used to be associated almost entirely with the moneyed classes, but according to the Investment Company Institute, 40% of mutual fund owners have family incomes below $50,000, and 68% have family incomes below $75,000. Moreover, 42% of those owning mutual funds do not have a college degree. Well, this raises some compelling questions. For example, if almost half of Americans own the means of production of American companies, might we perhaps be witnessing a most unexpected spike through the heart of Marxism, which after all was based on the idea of a constant struggle between wealthy capitalists and subjugated workers? And as more and more people have a stake in society's wealth, are we perhaps witnessing an erosion of the politics of us versus them? Have us become them? Gentlemen, thank you for joining us. Rick, what's going on out there?
Well, obviously what you said is true, that the percentage of people who are owning stock either through their company or directly buying it through mutual funds or 401k plans and so forth has grown. I do think it's important to remember the figure you cited from NASDAQ was 43%. That means 57% don't. 57% or nearly 60% of the people in this country own no stock whatsoever, and that's very important to keep in mind.
But the line is going steadily upward.
But the problem was your base figure was 1965. If you'd picked a figure somewhere around 1980, the growth really occurred between 65 and 80. It's continuing to grow up, but there still is a substantial percentage of people who don't know anything. But ESOPs, employee stock ownership plans in your own company, they've expanded, and that's important. That does give workers a stake in their company's future.
Okay. Dallas?
Well, you get the piece of the 401k plans and take federal workers. And that didn't happen until 1987, and now most federal...
Explain that.
Well, beginning in 1987, federal employees for the first time had a federal 401k plan and a cutback in the basic pension plan. So you now have most federal workers with a stake in the market. You have companies like General Motors that didn't do that and negotiate it with the unions until the early 1990s. And you've had a massive change since the mid-1990s, just in the last 3-4 years, of major corporations doing so-called universal stock options outside of even employee stock ownership plans. So as a matter of philosophy, whether it be by the Congress the federal government as an employer or employers across the spectrum, the philosophy of making individual employees participants in the capital markets is all around us.
Well, that's all entirely true, and it's been an enormous benefit as stock ownership has moved down into the middle class. The problem is it's going to stagnate there. It's not reaching down into the
So you're agreeing
core.
with Rick that
I'm agreeing strongly with
effect.
Rick, and I think that creates
I did not
a
expect
huge
you and
problem.
Rick to be agreeing. But that's all right.
Yeah, and it's going to lead to a big problem in the future because wealth accumulation really comes not from wages but from this capital investment. And what you're going to see is an even greater disparity in wealth in our country. Income disparity is actually shrinking, but wealth disparity is growing. If you look, for example, racially, blacks and whites, the income gap between black and white wage earners has shrunk and continuing to do that. But wealth gap between black and white families is actually increasing. And a big reason is that blacks have not participated in this 401k boom that white stakeholders have.
Dallas, you don't believe that, do you?
Well,
you don't believe what either of these guys are saying on this plateau stuff, do you?
It becomes a question of total distribution. It is true that half of the total labor force at any point in time isn't participating in these programs at work. And so definitionally, you are going to have some dispersion. I think the question becomes one of, short of some type of a mandate that says to individuals, you must invest in the equity markets, we're going to have tens of millions of Americans that will not choose to invest in the equity markets. Take even the people that do have the federal plan or other 401k plans. 20% of them, by choice, have no money in equities.
Well, it has to do with opportunity cost as
They,
well.
they have it in bond funds as
They have
opposed
it in
to
bond
the
funds
money
or
market.
fixed income investments or in a money market fund. They want nothing to do with
Or
the
they
risk
don't have
or the
it.
return.
You got it in a savings account. I mean, I think the point about wealth distribution is very important. I mean, there's some Dartmouth and MIT economists who did a study off the Federal Reserve figures that you were talking about, that is stock ownership. And what they found was that 1% of the stock owners in America own 50% of the stock. And 80% of the stock owners in America own 3% of the stock.
But the reason is opportunity. I mean, for the minimum wage worker or the guy making $20,000 a year, after he pays his food, his rent, his essential bills, he does not have a lot of discretionary income left over for investment. And most small businesses where those people work, they don't have pension programs or 401k programs. That's really become a middle class and up entitlement to get to that sort of wealth creation.
Well, let me just go back to this plateau thing. Let's just let me go back to Dallas one more time. It's gone from way low to 43%. Rick and Michael say, well, it's sort of plateaued, but the line, and you pointed out there's some reasons, that line is going up. Is that correct?
Well,
I mean,
number one, it hasn't plateaued. That's just wrong.
it has not plateaued.
Number two, it's continuing to expand. The state of Vermont just made the legislative decision to move to a defined contribution plan for state employees in Vermont. The state of Michigan is doing the same thing. These are first-time opportunities for what will be hundreds of thousands of workers. That means we're going to continue to see a trend line. We're going to continue to see better distributions.
So we are looking toward a country either now or pretty soon of where half the people own stocks.
And take the example, this distributional issue. Bill Gates owns a lot of Microsoft. He's a very wealthy man. But a lot of other people own Microsoft stock and have become wealthy over it. The fact that on an income distribution basis, Bill Gates has become extraordinarily wealthy and feeds the statistic that is an accurate statistic in terms of distribution, and therefore to say we shouldn't feel good about all the employees of Microsoft that are also gaining wealth through ownership in those shares.
Well, of course we should
it's directional.
Feel good about it, but shouldn't we try to expand that down, find ways to allow that minimum wage worker or just above to get in on this? Shouldn't we be trying to increase this or democratize this still further rather than just being sort of
Well, we're
satisfied?
in the process of doing all that. And the question is, do we want to continue to do it on a voluntary basis, or move to some type of mandatory approach.
Actually, I think that it is certainly true that it's going to continue to trend up. What I meant was not it was plateauing, but the rate of growth is slowing down. So I think that if we wound up in a decade with 50%, I don't think that would be surprising. But it is important if the other 50% don't have it, and if the shares are that radically differentiated. The other thing is that one of the great hopes back in the 1980s forward was that employee stock ownership plans would become more popular, the kind of things that's happened at United Airlines, Northwest Airlines, Avis, Chevron, a whole bunch of companies around the country. And it grew very rapidly, and that has sort of plateaued. Some of the companies that have had employee stock ownership have, at the end of the period, normally are 5-year agreements. Instead of continuing it, they've dropped it off, and they've made it voluntary rather than including everybody.
But
And
they've then added
Hold on one second.
universal
Let
stock
me just
options.
ask this unequity, disequity, the maldistribution of wealth, where 1% of the people own 50% of the stock. Take one of the people down low. Guy's just started working. He and his wife have just started working. They've just started putting money automatically into a mutual fund or a 401k or whatever it is. Their total asset value may be $5,000 or $10,000 for sure. It's way down on the scale.
Sure.
But because it's automatically deducted, and because of, as Ronald Reagan used to say, the magic of compound interest, you look ahead 40 years to when those people are going to retire, they're going to walk away with $1 million or $2 million.
Well, if that were true, Ben, those figures should have improved dramatically in the last 8 years, which has been a booming time for the economy and for the market. And those are figures that come out of 1997. They're not 1998 figures, but those are 97 figures. And in fact, what has happened is the disparity in the wealth in this country, wealth has increased. Just as was said earlier, the disparity in wealth has increased during a boom time. So what you're talking about hasn't happened. Maybe they've got more than they would have had they not been in there anyway. And let me be clear. I'm not saying this isn't good, that it's happening. What I'm saying is that the sense of being a stakeholder, that the market is your connection with the American economic machine, is acutely true of 43% of the population. But it's not for the others. And even for those who have it, and we've talked to people who've been laid off or they've been downsized.
No, I saw your television program where you dealt with it.
And you know, those people, you know, were counting on something, and then they wind up by having to cash in their stock option, and they're not in the market anymore. They lose their job, and the stock ownership was not a cushion for them. And that's one of the thoughts that's come out of this period, that if you had stock and you were in on an employee stock ownership or a stock option or a 401k, that if you lost a job, you got downsized, you had to move out of textiles or steel or electronics, whatever it is, that the stock ownership would cushion it. Well, wham, number one, the retirement fund is gone. And number two, often the funds are as small as you said, at the point that economic disaster, personal disaster hits people, and so it's not the cushion that everybody said it is.
Dallas, you have a problem
with a major problem. The most recent Federal Reserve data was collected in 1993. The most recent New York Stock Exchange fact book is presenting data from 1992. And everything since then is just a bunch of economists playing with numbers. So we've had a huge amount of growth in the equity markets and the number of 401k plans and all of this since 1993 that is not yet recorded. Now there's a new Federal Reserve survey that will be real data that's about to be published that was collected in '97, new Census Bureau data collected in early 1998, and we'll get another snapshot.
Okay. Now let's get to the bottom line in point of view of many people who are arguing where Social Security allegedly and ostensibly will be the #1 issue in 1999. Michael Tanner here is itching to tell us why it should become a totally privatized system, and we are going to hear from some other views. Michael, in short form.
Well, I'll leave aside the financial problems with Social Security, the fact that in 15 years it'll begin to run a deficit and won't be able to pay its benefits, the fact that it's become a bad deal where young workers are going to receive a negative rate of return out of the system. Let's stick to this idea.
Those are all the things you're not going to bring up.
That's all the areas I'm not going to bring up.
Right.
But let's
Thanks
just deal with this particular
Right, okay.
issue of the stakeholders. Because I think one of the most important things we can do in society is to broaden the number of stakeholders in our economy, to democratize that stock ownership down further so that that minimum wage worker or just above gets a share of this. Right now they are paying 12.4% of their income into a Social Security system that's going to provide minimum at best benefits. If they could take a portion or all of that 12.4% of their income and invest it in real wealth-creating assets, they would become shareholders in our society, they would become stockholders, they become capitalists. And I think that that would have a remarkable ability to transform the entire debate, political debate in our society.
Rick Smith, you have spent the first half of this program singing the blues about the 50% of the people who aren't getting their share. They're not getting into this stakeholder deal. Here, Michael is saying, I got the way to do it. Surely you must be in favor of that.
You're a clever man.
Yes,
Ben.
I am.
Very
That's why I
clever.
have this chair.
I think that if you take the attitude towards Social Security that a college or a church or some long-term institution would take towards its endowment, then it makes some sense to have a mix of investments, that the investment should be partly bonds, partly stocks, and so forth. But I think I hear Michael suggesting that, that each individual should be doing this because that's what's going to give them a sense of playing it. I think the markets are a lot more risky than that, and I would be uneasy. I would be uneasy with giving it to the individuals because there are at least 60% of the individuals, 57%, who haven't had any experience. And the suggestion that they're going to be able to manage their retirement money well is a risky one, number one. Number two, and let's assume they don't do well. Let's assume some of those folks aren't as good as the people and aren't as well connected as the hedge fund folks who can get a bailout from the Federal Reserve when they make a horrendous mistake in their
They
funds.
lost 90% of their money, of their equity, the bailees, just for the record. But
Yeah,
go ahead.
but there's still folks who can afford to do
Yes,
that. But let's
right,
assume these ordinary people don't get a bailout and they lose 90% of their funds. What are we going to do when they retire? Are we as a society really expect ourselves to be able to turn our backs on them and say, well, look, you know, back when you were 25 and 30 and 35, you got a small portion of your retirement money and you should have invested it wisely in the stocks, but you didn't. And now you don't have a retirement. Are we going to turn our back on all those folks? I don't think so.
But
No one is suggesting, though, that they be required to sit down with the Wall Street Journal and pick between General Electric and General Motors stock. We're talking about them investing in broad-based index funds. And over a 45-year working lifetime, there really is not much risk. In fact, if you take the average return to the market, so since markets have been recorded in this country, it's about 7.3% in the stock market, about 4% in the bond market. A mixed fund would be about 5.5%. If you're investing over their entire working lifetime, it's a very safe investment. And compare that with Social Security, which is $10 trillion in debt. They're going to have to raise taxes or cut benefits under Social Security, and people are going to lose money.
All right, hold on. Let's hear from the maestro here, who is awash in these numbers, who has a think tank that has numbers up to his hairline.
You get in the middle, and the key is what will people do? You can't assume everybody would choose to put their money in equities. In 401k plans today, where employers spend a lot of time educating people, 20% put nothing in equities. Another 20+% put all of the money in equities, and everybody else falls along a spectrum. You then look at that by age, and you get the under 20s, the 20-somethings, investing close to 65 to 75% in equities. By the time people get to 50, they're dropped down to about 35% in equities. So the number one uses and how you get to your assessments of how much people will accumulate ends up saying they need time for education. Even when they make a decision, they may choose no equities.
Sure.
And in deciding what we're going to provide as income for individuals in retirement or what a system will provide, we've got to look at the tremendous diversity of behavior.
Well, okay, as my old boss, Lyndon Johnson, used to say, therefore what?
Well, therefore what? To redesign a system based on the assumption that everybody is going to get great market returns is unrealistic. To move to total privatization, as was discussed, 12.4% of pay, as was noted, says that there are a lot of millions of people that will get far less under that system than they're getting under the current system.
Hold on one second. What about partial privatization, which is really the plan on the table now?
The partial approach, which looks at it as a 2% account, if it's not taking away from the basic structure, as most of those proposals, provides the option for individuals to build some of that capital while maintaining the social safety net. Doesn't say it's necessarily the right thing to do, but it's a much less risky alternative than a total shift. And per Michael, it ends up allowing my mom and dad at 85 and 82 to continue getting those checks. And my rate of return on my payroll taxes isn't what I'll get. It's what my mom and dad get.
If in the course of this next year of debate, you end up with a partial, say 2% of the 12%, nose under the camel's tent, kind of, camel's nose under the tent, wrong. Getting into this privatization idea, that's not so bad, is it?
It's better than the current system, but I wouldn't say that it's the only thing on the table. Senator Rod Grams of Minnesota has a full privatization bill which has now been introduced. There are several bills that go more than 2%, that Phil Graham's at 3%, Rick Santorum at 4%. Several bills in the House that go to full privatization. I just want to get away from this idea that stocks is the only way you accumulate wealth. If you put all that money into a bond fund and it got 4%, you'd be better off than under Social Security. Don't forget, for young workers, for the 30 and 35-year-old, they will get back less in benefits from Social Security than they pay in taxes. They will lose money under the current system.
But you know, Michael, that's a number, as a couple of others that you have bandied about, that I believe does not include the ancillary benefits of Social Security, like widows and orphans and things like that. Social Security is more than just a pension plan. I mean, it's got a wide array of social benefits, which are typically not included in those kind of numbers.
It includes survivors and disability benefits, and most of the privatization plans either leave the survivors and disability portion with the government and only privatize the retirement portion, or the full privatization plans also include privately provided survivors and disability benefits equal to or better than those provided by the government system.
We are about out of time, but let me suggest this. Let's go around the room once, starting with Michael, Dallas, Rick. Let's play the game that it is a year from now or a year and a half from now. We've been arguing and talking about Social Security, big issue. What is the resolution of this going to be in your judgment?
50-50 between they don't do anything or they have privatization of Social Security in some form. There is no chance that they're going to raise taxes, cut benefits, or allow the government to do the investing.
I think the most likely is minor modification from the current system. I think
Would that include some privatization, camel's nose under the tent?
I doubt that near term they can do that, because at least on our administrative studies, it'd take us 10 years to implement that. So maybe they'd enact it, but it'll take a long time to get from here to there. And one can do benefit cuts by the manipulation of formulas and other things that nobody really feels for a long time. So I think there'll be a lot of playing around the edges in order to get us beyond the 2029 period when benefits currently have to be reduced for real people.
And Rick, it's 15 months from now.
You tell me what the economy's doing, and I'll tell you what the political outcome will be.
Economy's doing fine.
Then I think there's a possibility that that there will be some minor change in the Social Security system to open it up. But my hunch is the economy isn't doing fine, and that there will be a great deal of wariness about privatizing Social Security. Wariness both political and philosophical. As long as the market is going up, there's a lot of willingness on the part of a lot of people to look at the kind of thing that Michael is talking about. When the market gets wobbly, everybody says, well, maybe later. And the rationale for it won't be any different, but the conditions for it won't be as good. And my hunch is that if the world economic situation continues to be fuzzy, it's going to, or worrisome, it's going to have an impact politically on what Congress is willing to do.
Okay. Rick Smith, thank you very much. Dallas Salisbury, thank you. Michael Tanner, thank you. Just for the record, I think the camel's nose will go under the tent. We will get a small amount of privatization of Social Security. It will be a monumental step in what I think is the right direction. Thank you for watching. For Think Tank, I'm Ben Wattenberg.
We at Think Tank depend on your views to make our show better. Please send your questions and comments to New River Media, 1150 17th Street Northwest, Washington, D.C. 20036, or email us at thinktank@pbs.org. To learn more about Think Tank, visit PBS online at www.pbs.org. And please let us know where you watch Think Tank.
This has been a production of BJW Incorporated in association with New River Media, which are solely responsible for its content.